Hi guys, I'm Lewis. Welcome to Investing Canvas. And in this video, I want to dive a little deeper into my actual investing philosophy, specifically the difference between discretionary and systematic investing and why I built my approach the way I have. First, this is not about getting rich quick. It's actually the opposite. It's about building wealth slowly, deliberately, and intelligently over a long time horizon. When we talk about discretionary investing, we're talking about making decisions based on judgment, opinions, narratives, or instincts. You read the news, you follow the economy, you listen to earnings, and then you decide what to buy or sell based on what's going to happen next. The problem, in my view, is relying on hunches or opinions is a fool's errand. Markets are extremely competitive. You're not just competing against other retail investors, you're competing against institutions, algorithms, PhDs, and billion-dollar hedge funds. If your strategy depends on "I think this will happen," it's not a repeatable edge, it's just hope dressed up as analysis. Systematic investing, on the other hand, is rules-based. You define what to buy, when to sell, and how much to allocate, and then you follow those rules consistently. It removes emotion, it removes ego, and most importantly, it removes panic. You're not waking up reacting to headlines, you're executing a process. That's the foundation of my philosophy. Everything I do is built around one core principle. This is a very long and slow process. There is no 10x month, there's no magic indicator, there's no secret stock. Wealth is built through compounding, discipline, risk management, and avoiding catastrophic mistakes. And the last one is critical. You don't need to hit home runs, you just need to avoid blowing up. One of the biggest mistakes investors make is concentration. They fall in love with one idea, one stock, one narrative, and they bet the farm. That works until it doesn't. Diversification exists for one reason: to protect you from being wrong, and you will be wrong sometimes. I will be wrong sometimes, that's guaranteed. Diversification ensures that a single mistake doesn't permanently damage your portfolio. It's not exciting, it's not glamorous, but it's essential. If someone asked me, "Lewis, what should I do if I don't want to think about investing at all?" my honest answer would be simple: buy a low-cost index fund that tracks the S&P. The S&P 500 represents 500 of the largest companies in the US. It's diversified, low cost, and historically resilient, but for most people, a totally hands-off approach using something like the S&P 500 is more than good enough. You don't need to overcomplicate this. In fact, overcomplicating it often destroys returns. Now here's where my philosophy adds another layer. I think, if done carefully, you can potentially improve outcomes modestly by applying structured rules and evidence-based factors, not predictions, not opinions, rules, things like momentum, mean reversion, risk management overlays, and position sizing frameworks. These are not guesses. These are observable tendencies that have appeared across markets for decades. The key is structure. You don't wake up and decide what feels right. You follow defined processes. If the process says reduce your exposure, that's exactly what you do. No drama, no second guessing. One of my biggest principles is that we need to avoid forced selling at all costs. Forced selling happens when you're over leveraged, when you're concentrated too much, when you haven't managed risk properly, or you need liquidity at the worst possible time. The market doesn't destroy investors, their own behavior does. If your portfolio is diversified, rules-based, and sized appropriately, you will give yourself staying power, and staying power is everything because compounding will only work if you're in for the long haul. So to summarize my philosophy, I prefer systematic over discretionary investing. I focus on long-term compounding. I diversify and never bet the farm. I think the S&P 500 is a fantastic default option for most people, and I apply systematic rules like momentum and mean reversion to improve outcomes slightly. Most importantly, I focus on avoiding catastrophic mistakes or forced selling. This approach isn't flashy, it's not exciting, but it's durable, and investing, in my view, should be boring. If you want deeper breakdowns of the frameworks and the models that I use, that's exactly what we build at Investing Canvas. Thanks for watching, and I'll see you on the next one.